Hey, I'm Angelo Datseris, and this is 3 points. First point, FHA's MIP reduction. So the mortgage insurance premiums on FHA have gone down. HUD has finally announced this long-awaited change that we've all talked about a few times, and it's now the time they have finally done it. Great news across the board, and it will affect all loans endorsed on or after March 20th this year, so basically right away. It's a big difference of lower premiums, helping increase opportunity for homeownership for so many people across the board when it comes to government financing. Basically, $300,000 loan, 30 basis point reduction is about a $900 yearly savings, $75 a month, so it's a big deal. Last time they did this was in 2015, so great change for FHA. Also, VA, 15 basis point reduction. For funding fee, not a huge change, but still a great change, both positive, going in the right direction for government loans. Now, Fannie Mae has also sunsetted their COVID guidelines when it comes to COVID-19 related selling policies. So like mortgage verification of history, variable income changes, all those has expired. So over the last 3 years that we've been having to deal with these COVID guidelines, those are basically gone. So I'm not going to go into all of those mortgage changes, but all real positive things from Fannie and Freddie, making positive changes that they recognize that COVID can be sunset permanently, and hopefully we can move forward with normal underwriting on all those things across the board with Fannie and Freddie. Now, third point, interest rates and affordability. So many people talking about that, right? They think, oh, higher interest rates means less people can buy a home, 30-year fixed rate. So listen, higher rate, of course, is more expensive than mortgage, right? It means less people can afford, but it's a very small number. So let's go through the data real quick. The data shows that if you went from 5% straight to 8%, so the massive increase, only 10% people less would be in the market to buy a house. So it's not like everyone can't buy a house anymore. So understanding the changes, so rates go from 6 to 6.5 or 6 to 7, that's not impacting anything. We realize that home affordability is important, right? To people buy houses, but it's not affecting the market like you think. People are still buying houses. The purchase market is actually much hotter than people think. And so thinking, oh, rates went up a point, I can't buy a house, people aren't buying houses. That's not the real estate market. That's just negative mindset. The real estate market is strong. The opportunity is still there. And even if rates go from 6.5 to 7.5 or 7 to 8, people are still out there buying and people out there shopping in the market today. Thanks for joining me. I'm Angelo Datseris, President and CEO of Leverage Lending Group, and that's 3 points.